Welcome to the Deep Dive. Good afternoon, and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We have pulled together, well, an incredibly dense stack of source material today. We're looking at Monday, October 28, 2025, and honestly, it was one of the most contradictory market sessions we've seen in quite some time. It just begs for a closer look, a real forensic analysis, because the headlines screamed euphoria, all-time highs.
Right.
But the data underneath, it was flashing some serious caution signals. Okay, so let's unpack this. Our mission today is to figure out how the major indices, S&P, Dow, NASDAQ, all managed to close at new records. Again, for the third straight session.
Right, that hat trick of records.
Exactly.
Yeah.
While at the same time, the market's overall breadth felt, well, profoundly fragile. We need to dissect what was actually holding this rally up. And maybe more importantly, what happens when those supports face the immense pressure that's coming later this week.
That fragility you mentioned, that's really the key theme from the 28th. The source material nails it, calling the market a holding pattern.
A holding pattern, okay.
Yeah, capital dispersion was just extreme. You had maybe a handful of giants pulling everything higher. But beneath that surface, investors were clearly hesitant, very cautious about committing capital broadly.
Because they were already looking ahead.
Precisely, bracing for what the sources are calling a high-stakes, two-sided event risk day this Wednesday.
Yes.
Yeah.
The double whammy. You've got the Fed's FOMC decision in the afternoon.
Right.
And then boom, right after the bell, Alphabet's Q3 earnings.
Right.
That's a heck of a tight squeeze for volatility.
It really is. And that's why we have to scrutinize the foundation these records are built on. It feels, well, exceedingly fragile. Because, frankly, these high market valuations, they're only really justified if both of those huge catalysts break bullishly.
Oh, God has to go right.
Exactly. Any sort of disappointment, maybe from the Fed, maybe from Alphabet, and you could see the market correct sharply. It could easily undo those 3 days of records almost overnight.
Okay, let's start with those headline numbers then, because, on paper, they look fantastic. The S&P 500 closed around 6,896. That's up, 0.31%?
Yep.
Modest, but a record.
A new record.
The Dow Jones Industrial Average also nudged into record territory, up about 0.3%. But the real leader, the one showing where the money was flowing, was the NASDAQ composite. It jumped a solid 0.8%.
Yeah, leading the pack again.
And like we said, all three hitting new highs 3 days running.
And that repetition, day after day, it gives this superficial impression of just unstoppable momentum, like everything's great.
Right.
But here's where it gets really interesting. As you said, that 0.8% gain in the NASDAQ, it was highly misleading if you look closer. The rally was defined by extreme concentration. We're talking maybe half a dozen mega-cap tech names.
There's a handful.
Driving practically all the gains. And it was all tied almost exclusively to this AI investment narrative.
So if you took those few big names out,
the rest of the market basically sat it out, barely participated.
And that concentration, that's the clearest sign of caution we've got, right?
Yeah. Absolutely. If the market felt genuinely confident about the economy, about where things are headed, you'd expect capital to spread out more. You'd see broader participation across different sectors, different company sizes.
Instead, the sources explicitly describe the leadership as narrow, focused just on AI and mega-cap tech.
And we can actually put a number on that nervousness. Just look at the market breadth divergence.
Oh, the classic warning signal.
It really is. So while the NASDAQ surged 0.8%, driven by those tech giants, look at the small cap proxy, the Russell 2000, the US 2000 index.
What did it do?
It was actually down 0.53% on the day.
Wow. Okay, so NASDAQ up nearly 1%, Russell down over 0.5%. That's a, 130 basis point gap?
Roughly, yeah. A huge divergence.
So why is that specific divergence so critical for you, our listener, to really track?
Well, it's a massive clue about investor psychology. Small cap companies, unlike the Microsofts and Nvidias of the world, they're much more reliant on the domestic economy. Local bank lending, cost of borrowing, that really hits them harder.
More sensitive to the immediate environment.
Exactly. So when investors get nervous, when they get cautious, what's the first thing they do? They often pull capital out of small caps. Because those smaller companies just have less wiggle room, less margin for error if interest rates stay high or if demand softens.
Makes sense.
So the fact that capital is piling only into the multi-trillion-dollar leaders, it suggests investors are playing defense. They're betting on the giants, the ones best equipped to weather a potential storm, rather than betting on broad economic growth.
So it's caution disguised as an all-time high.
Precisely. High watermarks, sure, but only the biggest boats are floating high.
And we saw this play out at the sector level too, didn't we? Technology was the obvious winner, sucking up all the positive vibes.
Clear leader. But then you look at sectors that are sensitive to the current economic climate, and they lagged badly.
Like real estate.
Real estate is a prime example. Highly sensitive to interest rates, right? Finished near the bottom of the pack. The sources even point to specific names, like Realty Income, often seen as a bellwether for REITs. It's down almost 2% on the day, down 1.94%.
So you've got tech running hot on future AI dreams.
Right. Speculative growth.
While real estate is getting hammered by today's interest rate reality.
That divergence perfectly sums up the 28th. Records were set, yes, but they were built on maybe 2 or 3 narrow pillars of AI strength. The rest of the foundation looking pretty shaky.
Okay, given how narrow this rally was, we really need to zoom in on those AI titans. What exactly was driving them on the 28th? It looks like the established giants were really flexing their financial muscles. Big-time consolidation, massive capital deployment.
Oh, the consolidation theme was spectacular that day. Just look at Microsoft.
MSFT.
Their shares climbed 2%. Not earth-shattering percentage-wise, but enough to push its market cap past $4 trillion for the very first time.
$4 trillion. Pause on that number. Incredible. And the catalyst wasn't earnings.
No, not directly. It was that landmark deal, acquiring a 27% stake in OpenAI, and crucially, restructuring OpenAI into a for-profit entity, the valuation. Roughly $135 billion.
That's breathtaking. It's more than just a partnership, isn't it? It feels like Microsoft is trying to lock down the future.
It's absolutely a strategic power move, designed to integrate OpenAI deeply, secure their access, solidify Microsoft's position right at the top of the AI software food chain. It's telling the market, look, we've got the cash and we will spend whatever it takes to own this next platform.
Then you shift to the hardware side. NVIDIA, NVDA, always in the mix.
The absolute darling of this AI generation, right? Their shares surged another 5% on the 28th. That was after a nearly 3% gain the day before.
So, strong momentum. What was their news?
Another major strategic move, a $1 billion investment and partnership deal with Nokia, the Finnish telecom giant.
Ah, Nokia. And this is where you see that ripple effect, right? What happens when you get chosen by one of these AI kings?
The market reaction is immediate and powerful. Nokia, NOK, as the recipient of that billion-dollar strategic investment, their shares just rocketed, up 24% on the news.
24%, just like that.
It proves the point. The broader market might be directionless, cautious, but when one of these ecosystem leaders deploys capital, it creates instant, massive value for the chosen partners.
And this is crucial. The market wasn't just throwing money at anything with AI in the description, was it?
Not at all, and this is fascinating. The market showed a really sophisticated ability to differentiate. It rewarded the leaders, like Microsoft and NVIDIA, for consolidating their power. It rewarded the direct recipients of their capital, like Nokia, but it was much more skeptical of companies trying to directly challenge those leaders.
Okay, hang on. If our goal here is genuine insight, isn't that kind of short-term reaction? Yeah, well, a bit irrational from a long-term innovation perspective.
How so?
Well, we're rewarding the status quo, right? If real innovation means challenging the established players, isn't the market actually discouraging future breakthroughs by being so tough on the challengers?
That's a really sharp observation. And you're right, market reactions are often driven more by immediate risk aversion than by, say, idealism about future innovation. Look at the perfect contrarian data point here, Qualcomm. Qualcomm. Okay, what happened there?
So just one day before the 28th, QCM shares had soared 11%. Big jump.
On what news?
On news that they were launching new AI chips. Chips specifically designed to compete with NVIDIA, particularly in the mobile space.
Okay, so challenger steps up. Market initially loves it. Then what happened on the 28th?
The QCM shares fell, dropped 3.5%.
So let me get this straight. The market loves it when Microsoft locks down OpenAI with its trillions.
Right.
Loves it when NVIDIA pours $1 billion into Nokia.
Check.
But when a dedicated chip company like Qualcomm actually tries to compete head-on with the most capital-intensive player in the game, NVIDIA.
The market basically says, hold on, prove it first.
Yeah.
Profit-taking kicks in, the enthusiasm evaporates.
Why? Is it just fear? It's that wait-and-see approach. But viewed through the lens of capital intensity, it's actually quite rational, if a bit brutal. The market understands that taking on a giant like NVIDIA requires absolutely colossal R&D spending. It requires manufacturing scale that takes years, maybe decades to build. It likely means brutal pricing wars.
A long, expensive, uncertain fight.
Extremely. So the market, right now, is aggressively rewarding stability. It rewards proven business models, ecosystem control, and it applies this massive risk premium, basically a show me the money penalty, to anyone trying to compete directly in these super high stakes areas.
So the differentiation tells us.
It tells us that while the AI story is incredibly powerful, the market's primary focus right now isn't just on who's innovating, but on who actually controls the path to profit.
Okay, moving away from those AI giants for a moment. Elsewhere in the market, the reactions to Q3 earnings were, well, extreme, almost punitive in some cases.
Definitely.
And this is where we see that clear investor mandate emerging. The sources call it the show me economy.
The show me economy. I like that framing.
It seems like operational efficiency, defending your margins, that trumps everything else right now, even top-line growth in some cases.
This divergence we saw between two major cyclical bellwethers really hammers this point home. It's the clearest signal of current investor psychology outside of tech. We're talking about United Parcel Service, UPS, and Royal Caribbean, RCL. Two household names telling completely different stories about market rewards and punishments.
Okay, let's start with the winner. UPS, stock surged. What was it? A massive 8%. Some reports had it even higher, like 10.9%.
Yeah, a huge move for a logistics company like UPS, right? Highly exposed to the economic cycle.
So what do they do right? Beat earnings.
They beat profit and revenue expectations, yes, but here's the critical detail. That beat came despite a 3.7% year-over-year decline in revenue.
Wait, revenue declined almost 4%, but the stock soared. How does that work?
Because investors completely looked past that top-line weakness. Why? Because UPS proved absolute ironclad control over its margins.
Okay, how do they manage that?
Aggressive cost-cutting. It was all about their Efficiency Reimagined initiative. This wasn't just trimming fat. It was a major structural overhaul. They cut nearly 50,000 positions. That led to $2.2 billion in savings just year to date.
Wow.
So investors are basically saying, okay, demand might be soft, we get it, but we love that you're controlling what you can control, your costs, your efficiency, your bottom line.
Margin discipline rewarded. Now, contrast that with the loser, Royal Caribbean, RCL.
A very different story. Their shares got hammered, lost 8.5% on the day.
Okay, and this is the part that feels backward at first glance. Didn't RCL actually report a stronger than expected profit?
They did. They were profitable, made good money, beat expectations on the bottom line.
So why the massive sell-off? What spooked the market?
It was triggered entirely by the top line. Their revenue for the quarter, while strong, fell short of Wall Street's expectations. Even though they were profitable, that revenue miss was immediately interpreted as a fundamental problem.
A problem with?
Either a failure of underlying demand for cruises, or maybe worse, a sign that their pricing power, their ability to charge higher ticket prices, had finally hit a ceiling.
Okay, I see the numbers, but still. That divergence is stark. You've got a 16.5-point swing between UPS and RCL.
It's a huge difference.
UPS is literally shrinking its business by nearly 4%, but gets cheered for cutting costs. RCL is still growing, still profitable, but gets punished for not growing quite as fast as analysts hoped. Are investors really saying they prefer managed decline over profitable growth right now?
In this specific climate, the data strongly suggests yes. When you have high interest rates, geopolitical jitters, predictability becomes paramount. The market sees a revenue miss, like RCL's, as potentially a fundamental failure driven by external factors. That's scary. It hints that consumers or businesses might be pulling back spending.
An uncontrollable risk.
Exactly. Whereas margin defense, like UPS showed, that's viewed as an internal success, a sign of sharp management, good discipline.
Yep.
Investors are prioritizing that corporate efficiency, the ability to protect the bottom line, even if it means lower volume or slower top-line growth.
Message is crystal clear then.
Control your costs, prove your margin discipline, or prepare to face the market's wrath. That's the show me economy in action.
All right, let's shift gears a bit to the bigger picture, the macro environment. On October 28th, we actually got a bunch of economic data releases. And most of it came in stronger than expected. But the market seemed to just Shrug it off.
Completely shrugged it off. It just shows how utterly fixated the entire system was and still is on the Fed's upcoming decision.
What data did we get?
Well, you had the Conference Board's Consumer Confidence Report, came in at 94.6, which was better than the 93.4 forecast.
Okay, positive sign.
We also got the Richmond Fed Manufacturing Index. It rose to -4. Still negative, but way better than the -12 expectation. That's a significant beat.
Normally, stronger data like that, especially manufacturing and confidence, that would make people worry the Fed might stay hawkish, right? Delay cuts.
Typically, yes, it would definitely fuel the hawkish narrative. But the market had already priced in, with like 98% certainty, a dovish rate cut from the Fed. That expectation just completely swamped these incoming data points.
But even inside that consumer confidence number, there was that familiar divergence theme again, reflecting the market's caution.
That's a great point. The headline number was up, but you have to look at the components. The present situation index, how people feel about jobs and finances right now, that actually gained 1.8 points. People felt okay about their current situation.
Which lines up with things like strong travel spending we saw with booking holdings later.
Exactly. But then look at the expectations index, the short-term outlook, where people think things are headed.
What did that do?
That declined. It fell to 71.5. And here's the crucial context. That 71.5 reading is still way below the critical 80.0 threshold.
And it's been below 80 for a while.
It's been stuck below 80 since February 2025. And historically, that 80 mark is important. When consumer expectations consistently stay below it, it often signals a deeper worry, a structural shift that can precede an economic downturn by, say, 6 to 12 months.
So feeling okay today, but pretty worried about tomorrow.
That's the gist. And the market basically ignored the okay today part and remained laser-focused on the Fed alleviating the worried about tomorrow part.
Okay, so if the market ignored the economic data, what else was influencing sentiment? We need to look at the cross-asset signals.
Absolutely. And this is where things get really interesting, especially regarding geopolitical risks.
Let's start with treasuries. What were bonds doing?
Pretty much nothing. The 10-year Treasury yield closed unchanged at 3.98%, flat.
Total pause mode.
Complete wait and see ahead of the FOMC. No one was making big bets on rates that day.
But commodities, different story.
Very different. We saw significant moves there. WTI crude oil futures, they fell sharply, down 2.3%, closing just under $60 a barrel at $59.90.
Okay, oil down. What about gold?
Gold pulled back too. Futures were down over 1%, settling around $3,966 an ounce.
Hold on. Oil down and gold down. On the same day that equities are hitting records.
Precisely. You have a classic safe haven asset, gold, selling off, and you have an inflation and geopolitical hedge, crude oil, also selling off at the same time.
That simultaneous drop is a huge cross-asset clue. What's the interpretation?
It signals a significant removal of geopolitical risk premium from the market.
Explain that. What's geopolitical risk premium?
It's basically the extra price investors are willing to pay for certain assets when they're worried about global instability, wars, trade disputes, things like that. Gold is the classic hedge against general chaos. Oil often prices in fears of supply disruptions or potential tariff impacts.
So if both are falling.
It means investors are becoming less worried about those external risks. They're unwinding those protective hedges.
And why were they suddenly less worried on October 28th?
The timing points directly to the growing optimism, maybe even expectation, of a positive outcome from the upcoming Trump-Xi meeting on Thursday. A potential U.S.-China trade truce.
So the market was already starting to price in a deal.
It seems so. Investors were actively reversing positions they might have held to guard against, say, new tariffs on rare earth minerals or major supply chain problems. They were removing that risk cushion.
So part of the reason equities felt euphoric wasn't necessarily pure economic optimism.
Exactly. It was partly just relief, a rush to unwind hedges as fears of a trade war escalation faded, at least temporarily. That unwinding provides a technical boost to risk assets like stocks.
Okay, but that positioning creates its own risk, doesn't it?
Absolutely critical point. It means the market has already factored in a positive outcome for the Trump-Xi talks. That leaves the entire market incredibly vulnerable if those talks on Thursday fail to deliver the expected truce. The disappointment could be severe.
Okay, so the market closes on the 28th, records are set, but the underlying tension is palpable. Then after the bell, we get more earnings reports.
More pieces to the puzzle.
And they immediately seem to reinforce that divergence theme we've been talking about. They gave us two really different, really critical views into the health of the consumer.
Yeah, a real split decision from the consumer wallets. First, we saw pretty robust strength demonstrated by Booking Holdings, BKNG.
The big online travel company.
Exactly, global leader. Their stock surged after hours, up over 5%. Why? A comprehensive beat on earnings and revenue.
What were the numbers?
Adjusted EPS came in strong at $99.50. Consensus was around $96.04, and revenue hit $9.01 billion, beating the $8.74 billion expectation.
Okay, so people are definitely spending on travel. Flights, hotels, experiences.
Absolutely. It's a direct signal of strong consumer spending, at least in that services and experiences category. It lines up perfectly with that strong present situation confidence data we talked about earlier.
People feel good enough now to splurge on a vacation.
Seems that way, but then we saw the other side of the coin. The darker side of the consumer economy, maybe.
Which came from?
Mondelez, MDLZ, the giant consumer staples company. Think Oreos, Cadbury chocolate.
Household staples, comfort food.
Exactly. Their stock dropped after hours, down 3.75%.
Okay, so Booking up 5%, Mondelez down almost 4%. Why the drop for Mondelez? Did they miss earnings?
Not exactly on the headline revenue. Net revenues were actually up 5.9%. Looks okay on the surface.
That's always a but.
There's a big but. This is a classic margin problem unfolding, and it's critical for understanding the broader market pressure. That 5.9% revenue growth. It was driven entirely by aggressive pricing. They hiked prices significantly, adding 8.0 percentage points to their sales growth.
8% from price hikes alone. Okay, so what happened to volume? Are people buying less because it's more expensive?
Bingo! That aggressive pricing led to significant demand destruction. Volume mix, the actual amount of stuff people bought, was negative 4.6 percentage points.
Ouch. So they sold less stuff but charged a lot more for it.
Exactly. And this is where you see that stagflationary pressure really biting. Mondelez explicitly blamed this volume decline on record high cocoa cost inflation.
Cocoa prices have been through the roof.
Absolutely. So Mondelez found the limit. Even for popular snacks, consumers are pushing back. They're saying, okay, I love my chocolate, but with 8% price hikes on top of everything else getting more expensive, maybe I'll buy one less bar this week.
So this raises a huge question, doesn't it? If a massive company selling affordable, almost essential comfort items can't maintain volume because of input cost inflation.
Right. What does that signal for everyone else?
What about companies selling less essential goods or goods where price hikes are even more noticeable?
It's a massive warning shot across the bow for all consumer-facing companies. It shows that the era of easily passing on higher input costs might be ending. Consumers are hitting their limit. And when you combine soaring input costs like cocoa with declining sales volume, that's the textbook recipe for a margin squeeze.
And the market punished Mondelez instantly for it.
Aggressively. Because that margin focus, that fear of inflation hitting profits, is absolutely top of mind for investors right now. And that specific fear becomes terrifyingly relevant when we look ahead to Wednesday's big test.
Okay, so we've established the scene. Record highs built on narrow strength, some relief from geopolitical fears, but clear warnings from earnings about margins and consumer limits. Now, the market is walking into Wednesday facing maximum volatility. Two huge non-rate related events that will immediately stress test these high valuations.
It's a genuine trial by fire for the current market levels. Let's break down the two tests. Test number 1 comes at 2:000 p.m. Eastern, the Federal Reserve's FOMC decision.
And this test is really about liquidity and crucially about future expectations, right?
Exactly. The actual rate decision itself feels like a done deal. The market is pricing, 98% probability of a 25 basis point cut?
Yeah, bringing the target rate down to that 3.75% to the 4.00% range, it's fully baked in. So the cut itself won't move the needle much.
Correct. It's already in the price. The market reaction will hang entirely on the forward guidance. Specifically, what Fed Chair Powell says in his press conference afterwards.
What's the market expecting him to say?
Well, here's the rub. The market isn't just pricing in this cut. It's already pricing in a 94% chance of another 25 basis point cut coming in December. Very aggressive pricing.
94% for December, too. Wow.
Yeah, and that leads directly to the biggest risk from the FOMC meeting, the hawkish risk.
Meaning Powell could push back on that December expectation.
Precisely. Given the stronger consumer confidence data, the better manufacturing numbers we just talked about, Powell has ammunition if he wants to signal caution.
How might he do that? What language should we listen for?
He could reference that strong present situation data. He could heavily emphasize strict data dependency, meaning they aren't pre-committing to anything. Or the real killer would be if he removes language from the statement that suggests further accommodation is likely or guaranteed.
If he does any of that, even subtly.
It would be seen as a hawkish surprise, a hawkish cut. The market would be forced to rapidly reprice those December expectations. You'd likely see the short end of the yield curve jump, the US dollar index would probably spike.
And equities would sell off.
Almost certainly. So that's the risk.
Okay, so if the rate cut itself is priced in, and pushing back is the risk, where's the potential upside surprise? What could Powell say or do that would actually boost the market further from these highs?
The real opportunity for a dovish, bullish surprise lies not in the rate itself, but in the Fed's balance sheet, specifically quantitative tightening, or QT.
Right, QT. That's the process where the Fed lets its bond holdings mature and roll off without reinvesting the proceeds.
Exactly. It's been happening in the background, effectively draining liquidity, shrinking the money supply month after month. It's a form of tightening, even while they might be cutting the headline rate.
So the market's hoping for.
An update on the timeline for ending QT. Any signal, any hint that they might end the balance sheet runoff earlier than previously expected, that would be huge. It would stop the active drain of liquidity. It would be a powerful new dovish signal, maybe even more impactful than the rate cut itself at this point.
Okay, so that's test one, Powell's press conference and the QT question. Now, test two hits right after the market closes on Wednesday.
Test 2, Alphabet. GOG earnings. And this isn't just another earnings report. It's being framed as a referendum on the entire AI margin story.
A referendum. Why such high stakes for Google?
Because of the core conflict playing out within the company and within the whole AI narrative, the massive cost versus the uncertain immediate profit. Analysts expect Alphabet to report strong revenue growth, maybe around 13%, potentially getting close to a $100 billion quarter. Huge top line.
Sounds great. What's the problem?
The problem is the bottom line. EPS growth is expected to be much more modest, maybe only 7–8%, hitting around $2.28 per share.
Okay, so a big gap between revenue growth and profit growth. Why the disconnect? Where's the money going?
It's going directly into massive internal cost inflation, driven almost entirely by management's absolutely unprecedented commitment to the AI arms race. We're talking about their stated $85 billion AI capital expenditure plan for 2025. $85 billion.
Just let that number sink in. $85 billion in 1 year on AI infrastructure and development.
It's staggering. That annual CapEx plan rivals the entire net income of some of the world's largest corporations. So the market needs proof, hard proof, that this colossal spending is actually translating into tangible, monetizable results right now. Not years down the road, now.
Okay, so what specific metrics will tell us if they're delivering that proof? What matters most?
Two things are paramount. First, Google Cloud Platform Revenue, GCP.
Their cloud business. They need to show it's benefiting from AI demand.
Absolutely. Investors need to see ironclad return on investment for that CapEx spend. The target expectation is steep, maybe a 30% jump in GCP sales, hitting around $14.7 billion for the quarter.
And if they miss that GCP number?
It would be seen as potentially catastrophic in the short term, interpreted as operational failure. A sign they can't effectively monetize the AI demand they're spending so much to capture, or that the spending is just wildly outpacing the revenue generation.
Okay, GCP is metric one. What's number two?
Number two is the health of their golden goose, the core search business and its monetization. They need to prove that all these new AI features they're rolling out, like AI overviews and search results, that they are successfully defending their core commercial search revenue, that lucrative ad revenue needs to hold up.
What's the risk there? That the AI answers cannibalize the ad clicks?
That's exactly the fear. If the AI features, while maybe helpful to users, end up disrupting the highly profitable ad ecosystem that funds the entire company, the stock will crater.
And this is where that Mondelez earnings reaction comes back as a chilling warning sign, isn't it?
It's a direct and terrifying parallel. We just saw MDLZ get punished severely because rising cocoa costs squeezed their margins and hurt volume, a relatively small input cost in the grand scheme.
Now look at Alphabet.
They're not dealing with cocoa costs. They're asking the market to stomach $85 billion worth of AI cost inflation. If Alphabet cannot convincingly prove a tangible near-term ROI on that $85 billion AI spend, if they show margin pressure because of it, the market reaction could be brutal. It won't just be punishing a bad quarter. It could cast serious doubt on the entire profitability thesis of the AI investment cycle, at least in the near term.
That's why it's a referendum. It's bigger than just Google.
Much bigger. It impacts the valuation justification for a huge chunk of the market's leadership.
Okay, so massive focus on the Fed, and Alphabet. We should also quickly mention there are other important earnings sandwiching those events.
Right. Before the bell Wednesday, you've got industrial giants like Caterpillar, CAT, Boeing, BA, healthcare with CVS, and Verizon,
Hmm.
VZ. Then after the close, alongside Google, you also get Visa. Lots of economic signals there, too.
And woven through all of this, the market will remain hypersensitive to any whispers or headlines about the Trump-Xi meeting scheduled for Thursday.
Especially since, as we discussed, that optimism seems partially baked into asset prices already, particularly in commodities.
Okay, so the stage is absolutely set for potentially extreme volatility compressed into just a few critical hours.
Ooh, couldn't have said it better myself. So just to synthesize this whole precarious setup, that third straight day of market records, it really rests on an incredibly fragile foundation. It's fueled by very narrow AI leadership and, significantly, by this optimistic unwinding of geopolitical risk premium and those high valuations we're seeing. They're only really justified, only make sense if both the FOMC outcome and the Alphabet earnings catalyst break decisively bullish.
A lot has to go right.
Which means a hawkish cut from Powell, where he cuts rates but sounds cautious about the future, or any sign of a significant margin squeeze, or a GCP miss from Alphabet.
Either one of those, independently or certainly both together, could trigger a really sharp, really immediate correction, pulling back hard from these all-time highs. The market seems priced for near perfection on both fronts. And, well, perfection is rarely delivered. So we talked about how gold and oil fell, partly because investors were shedding geopolitical risk, feeling optimistic about a U.S.-China trade truce. Here's something essential for you, the listener, to really mull over as you watch things unfold tomorrow and Thursday. What happens to market positioning if those Trump-Xi talks don't deliver that expected positive outcome?
Mm-hmm. What if the optimism was misplaced?
Exactly. What happens if that geopolitical risk premium is forced to rush back into the system? You can see those commodity losses rapidly reverse into gains. That disappointment would land as a third powerful downside catalyst right on the heels of the Fed and Alphabet results. Just think about how quickly capital might have to reverse course if that trade optimism proves unwarranted. A sudden flight back to safety, back to defensive positioning that the market seemed so quick to abandon just days before. Something to definitely keep in mind.